Now we get to turn to my favorite topic of China. It's definitely a lot to talk about, especially when you look at some of the comments that were made in YouTube and some of the comments that have been made to me on Twitter in terms of, that I don't understand what's happening or a misunderstanding how the CCP, what they're doing. But it's funny because they've now come out and they're now supporting private industry again, because even though it is a communist nation, they do have state-owned enterprises. The majority of their economy is still driven by the private sector. And it's going to be difficult to get things running again unless they get that up and running. But again, there's so many issues that they're facing, which is why we want to talk about these key pieces and then look at the data points on why we think there's going to be more trouble ahead. So the new home prices month on month, last month was the first month that they were positive. This month they came in negative 0.06%. Now, the reason why that's a problem, and again, it's small, I'm not saying it's big, but that's a key component of how people, especially in the consumer world, that's how they were looking to get back to flat. They need this price appreciation, but then in the quote unquote stimulus or the fourth arrow, as we talked about last week, they talked about how they actually want prices to continue to fall. So prices continue to fall, it's going to put more pressure, not less, on the underlying consumer. Medium-term lending facility rates were held flat. Medium-term facility rates were held flat. And again, if you look at the volumes, the volumes were expected to be at 125 billion. They came in 103. None of that is stimulus. And what we keep trying to say is it doesn't matter, even if they cut rates, it's not driving more credit demand. People are saturated with credit. GDP for year on year was expected at 7.1, came in at 6.3. The quarter over quarter, expected at 0.8, came in at 0.8. GDP year to date expected at 6.1, came in at 5.5%. And when you look at all the data that has come out, Goldman, Morgan, JP Morgan, they've all taken down their estimates closer, anywhere between 4.8 and 5.2%. And as we've been saying, it's going to go down further. Industrial production expected at 2.5%, came in at 4.4. Retail sales expected at 3.3%, came in at 3.1. Fixed assets was expected at 3.4, came in at 3.8. Resident property investments expected at negative 7.5%, came in at negative 7.9. And then the jobless rate was fairly fixed. Foreign direct investment was expected, came in at negative 2.7%, which is something that's going to continue. 5-year loan prime rate, it held flat. 1-year loan prime rate held flat. Again, none of that is stimulus, even as things continue to weaken. So the headlines in general, the economy expanded at 6.3% compared with 4.5% in Q1. But then the GDP print was a big miss because the consensus was much higher. Nominal terms, GDP growth last quarter actually fell from 5% growth in Q1 to 4.8%. So again, wrong direction. Retail sales down, fixed asset investment, when we're going to debunk some of that in terms of it's actually much worse. Value added output, it came in at 4.4. Growth is increasingly reliant on the state sector. SOEs increased investment 7.4% in June. Private firms cut investment 0.6%. So again, that bifurcation, which is why they're trying to drum that up, because they're pushing this massive investment from an SOE side. I mean, 7.4% year on year. But yet it's not translating into more growth. Infrastructure spending growth hit a 4-month high because, again, they're pushing infrastructure. But we're going to show you how it doesn't matter, because the LGFVs or the local government financing vehicles, which are driving that infrastructure spending, can't afford to do it anymore. Real estate investment dropped 10.3% year on year. State spending can only get the economy so far. The private sector is, again, vital to economic growth. Economic malaise means businesses are reluctant to hire new staff. Graduate unemployment climbed even higher last month to 21.3%, a new record. The dire performance in Q2 means that without effective stimulus measures, there is general risk China won't hit this year's growth target of 5%, which again is our base case. To avoid this outcome, they need support of the private sector and households, which, as we've been saying, is not coming. So now when we start looking at the different pieces, they talk about trying to ease mortgages to spur home buying. But Beijing's running out of ways to stimulate the economy. On Friday, the State Council called for constructing civilian emergency dual-use infrastructure in large cities. Okay. So, but this refers to hotels that can be adopted into quarantine and treatment centers during public emergencies. Again, this investment splurge is part of the government's failing efforts to revive the economy. That just is insane if you think about it. So now you're going to try to do it by building hotels that can be two things. It's like you hear it and you're like, I'm sorry, what? What now? So specifically encouraging more private firms to participate in the construction, adoption, operation, and maintenance of these facilities, revitalizing inefficient and idle state assets, because again, they need the private sector, which is why to believe all of this can happen from the top down is why all of communism has failed in previous cycles and previous tries, and this one is no different. The impact on the macroeconomy is going to be muted in general just because there's already oversupply. For one thing, the policies only focus on large cities. For another, cash-strapped local governments who assume will try to put up this cash are going to slow it down because they can't finance their current ones, let alone this, which would have a terrible payback period in terms of underlying timing. So when you look at it in general, policymakers are desperate to get the economy moving, but they need to boost household incomes, confidence, and spending, which again remains an underlying problem. So now when we look at China's rate cuts have yet to lift the credit cycle. And again, they cut some, but then they just defaulted. So 1 year, again, all of this is leading to what we've been talking about, where you're getting that bifurcating, weakening recovery. China's growth is losing steam, and we don't see that changing, especially when you look at Wanda and Shu on notes extended this week's plunge, as you're seeing, again, more credit stress. China's high-yield dollar bonds suffered their sharpest three-day sell-off this year with a fresh default from a state-backed developer, underscoring a liquidity crisis is worsening. Greenland Holdings, which is partially owned by local government entities, has defaulted on a 6.7% dollar bond it guaranteed, according to notices. That comes as state-backed Sino-Ocean Group Holding proposed repaying a local note over 1 year. So again, state-backed, SOE, there's all these problems. And we're not trying to say it's just there's so many issues that everyone keeps trying to point to. Oh, this is an issue because of this. And then that issue that they said which makes this obsolete, it gets blown up in their face, which is why there's so many hidden landmines, which we're going to continue to uncover. China's Communist Party and government issued a joint pledge to improve conditions for private businesses in a signal that Beijing wants to bolster corporate confidence. China vowed to treat private companies the same as state-owned enterprises from the party's Central Committee. Governments at various levels are also encouraged to invite entrepreneurs for consultation before drafting and evaluating policies. China has shifted its tone toward the private sector after wrapping up a multi-year crackdown on tech firms and imposing over $1 billion in fines on Ant Group and others. Again, China's efforts to revive growth, ranging from lower interest rates, easier access to credit, and a series of measures to kickstart the morbid housing market, have done little to bolster the economy. And that is not going to change. China's recovery lost momentum, and that loss is going to continue because, as we've been saying, it's not that there is no demand for credit. It's just when you look at it in general, borrowing has slowed. It hasn't halted. It's slowed, and it's going to continue to slow because there is no pent-up demand. The pent-up demand has been taken care of. It's been taken out, and that's going to push down. So even if you cut rates, nobody's coming in to increase their leverage because they're already levered, which is why when you look at this imbalance between consumption and investment, final consumption expenditures, when you look at China's economy, is overly reliant on property and investment, while its household spending as a proportion of GDP lags. So again, they rely on fixed investment. They rely on infrastructure, not the consumer. And given how many losses the consumer has taken, that is not going to change anytime soon, especially as China's unemployment rate, especially on the 16 to 24-year-old, hits those new highs. But here's a funny piece. So speaking of the absurdity of the data, so this was the official China's government statistics in 2022 report on July 2022. Fixed asset investment was 27.14 trillion. 2023 official figures was 24.3 trillion. But yet somehow China reported a 3.8% growth, with fine print saying figures have been adjusted for various reasons, but most media is oblivious to that because, again, how do you have growth of 3.8% if it fell? Which, again, why we point to how you have to take the data for what, a grain of salt. But if they're announcing declines, it's not likely they're undershooting and they're going to, all of a sudden there are these massive hidden benefits. It just means that the declines are worse and the beats are probably not beats at all. And that's why we continue to see this pervasive problem within China. Even the Target is now at risk. Citigroup lowered their China's growth this year to 5%. Morgan Stanley also to 5%. And then JP Morgan took it down to 5.5%. And it's all based on, again, these underlying slowdowns, which we think are accelerating. And even this data that is making it up is likely much lower. China's retail sales flatlined. Chinese households are more cautious. So again, we're hearing this almost day in and day out, that they want to target policy steps are needed to keep the task of to boost domestic demand and shoring up consumption on China's work agenda. But while everyone now seems to agree that consumption must play a larger role, and that for this to happen, there must be an increase in household income. No one seems to be discussing what that costs and the constraints on it. It's not enough for household income to rise. For consumption to play a larger role in the economy, the household share of GDP must rise, which means that after decades of transfers from households to subsidized manufacturing and investment, these transfers must be reversed. Implies a transformation in the structure of the economy and requires that adjustment cost to be absorbed by some sector, most probably the local government. But again, how can they absorb it if they've been absorbing so much pain already, which is why we don't see retail sales getting better. We don't see any households getting less cautious, and we don't see an acceleration of spending. Manufacturing capex is continuing to slow. China's export by country, when you look at where they're exporting, Russia's the largest, BRICS is the second, and then everything else is in decline. Most analysts expect the economy to grow, which means China will drive the global economy. This is based on the misunderstanding of Chinese growth. If China were able to achieve GDP growth of over 5%, driven by surge in consumption and an associated surge in business and investment, China would indeed help drive the global economy. But the declining gap between Chinese savings and investment would mean a contraction in China's trade surplus that would add demand to the global economy, and Chinese imports outpaced. But if China's 5% GDP growth is driven mainly by infrastructure and other non-productive government spending, as has been the case for this year so far, there's no way for that to add to global growth, which is why this view of this like saving grace of, oh, don't worry, China will dig us out, it's just not possible at this point in time. So Beijing's economic policymakers clearly distinguish between high-quality economic activity and other. This for two different types of growth, and that's where we see this imbalance as industrial production slightly bounced, but the consumption recovery slows. When you look at the trend prior to COVID and now post-COVID, you're getting something similar where you're getting this flatlining, and that we don't see pivoting. Then when we turn again to China property investments, still negative. Newly started residential real estate construction, again, steeply negative in terms of missing the pace previously. Chinese households are still cautious. Consumer preferences, when you look at more savings, hasn't pivoted. More investment is still on the downside with more consumption flatlining. And again, it's just because there's no real pivot at this point in time. Outstanding local government bonds as a percentage of GDP continues to rise as the China's credit impulse is negative. As we've been saying, there just isn't that demand, as the PBOC has now stepped in to try to protect the CNY. A growing number of LGFVs are struggling to service the interest payments on their mounting debt. They've turned to private fund managers who carry out these restructured issuances to help risky borrowers. Fund managers help the borrowers package their debts into asset management products to facilitate financing and skirt regulatory oversight. However, while officially banned, structured bond issues aren't technically legal. LGFVs that are financially weak have become the major users of such issuance, which have become particularly risky, which is why, consumers aren't stupid. They've gotten wise to that, which is why they're not looking to invest, because how do you know the sanctity of what you're investing in? There are deeply intertwined interests behind LGFV structured bond issuance. Although there hasn't been a wave of defaults yet, it will be coming. And that's why when you start looking at some of these others that have utilized it, such as the less developed regions, including Qinghai, Jinzhou, may have over 25% of their LGFV bonds involved in such practices, which is going to be a huge issue. Let's look at India. India wholesale prices expected to be down 3.3%, came in down 4.12%. That's a positive. Exports were down 22%, imports down negative 17.5%. Again, that is a problem when you look at, but again, something similar that we've seen across other regions, especially in Asia. Japan industrial production came in at negative 2.2%. The trade balance, again, exports were expected to be up 2.4. They were only up 1.5. Imports were expected to be up 11.3. Imports were expected to be down 11.3. They came in down 12.9. Again, a big miss when you look at just what the reiteration is in terms of local demand, export demand, more negative pieces going forward. And looking at India in terms of just where, the fall and price index is a positive, but again, exports are trending down and are now at 2021 levels and falling, which is something that we think continues. As just looking at here, Taiwan export orders are moving lower. Taiwan export orders continue to decline for the 10th straight month, with a 25% drop in June. Mainly due to weak demand and inventory adjustments. And that's where we continue to see more pressure when you look at Asia in general, because there's really no bright spot on the export order front as things in the developed world continue to slow. So that's what we have for you here. If you have any questions, please let us know. We'd love to hear from you, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.